Hello, everybody. This is Manoj Kulwal. I am the facilitator for this workshop, and this is the second of the three sessions we're doing on the topic of best practices for assessing op risk and controls. So what I'm going to do is I'm going to just quickly recap the topics we learned yesterday, and then we will cover some of the new topics of today's session. So recap from yesterday was that risk assessment is mainly a measurement exercise where you're trying to measure different risks so you can identify which risks have high risk exposure and which risks have low risk exposure, so that based on that you can then decide which risks need to be escalated, which risks may require additional remediation actions, or which risk may require closer monitoring. And then the idea of risk assessment is that it should not be an exercise just for the sake of it, that it should enable effective management of your business in terms of either your business strategy or achieving your objectives or improving the effectiveness of your processes, improving the productivity of your people, and increasing the reliability and availability of your assets. Here's visually how you can sort of look at risk assessment, where on the left-hand side, you need to identify the right risks. And then in assessment is where you're assessing. So that's why some of those circles then become bigger. And then once you've done the risk assessment, then you can categorize those risks based on escalation, remediation actions, and close monitoring. Here are some of the triggers of when should you do risk assessment in your organization. So whenever you're making any big business decisions, whenever the senior management is defining the business strategy and the objectives, when you need to develop scenarios, and these can be business scenarios or risk scenarios, when something significant happens inside your organization, which may require you to reevaluate your risk exposure, or if something significant happens outside your organization and you may want to review your risk exposure. And then, of course, whenever you want to do a point in time, which is what I referred to yesterday, is like getting your car servicing done, once a year. So risk assessment can also be due, but then it'll only give you the view of the risk at that point in time, and that's what typically a lot of organizations do from the RCSA perspective, or internal auditors may do that in order to prioritize which business units to audit. Okay, so those are the 6 triggers. And then we did a poll yesterday, and I think a majority of you said that it's periodic is where I think was one of the most common functionality, or one of the most common areas where assessments are done. Then when to assess risk. So I also shared then some guidance from the Principles for Sound Management of Operational Risk document, which was published by the Basel Committee in August. So they also sort of are reiterating that message that operational risk assessment should be part of defining strategy, executing strategy. It should also be used, when making business decisions, like when you are considering any new business opportunities. And then they talk about continuous risk and control assessment, which is also important, that as things change, you need to also make sure your risks are assessed at that point. And another point, just evaluating and reiterating that that it needs to be part of any changes which may be happening inside or outside your organization. Then I had also shared the findings from ORX, where they did an analysis on the state of RCSAs. They did an analysis on the state of RCSAs across 73 firms who are their members. And these were some of the findings, and I'm not going to go through each finding, but basically it paints a very poor picture of how risk assessments are in most financial services organizations at the moment, that in spite of spending millions on operational risk frameworks and processes, we're still not getting the output we need. That yes, we are able to get those reports we need to give to our risk committee, but there's a lot of question mark on the quality and whether we are getting the right information in the risk assessment, and then are we able to make sense of it and use it for running the business. And then we had done a poll around the risk assessment challenges, and I think those first line related challenges had sort of come out on the top, that there's very little buy-in from the first line. They don't see the benefits of doing those risk assessments, and they require a lot of escalation and pushing to be able to complete those risk assessments when they are due. Then we had looked at some of the reasons of why we are in this current state, and then a lot of this is related to that the board and the senior management have not done enough to integrate risk management into the core business activity. That in a lot of organization it's been separated from the day-to-day activity, and then the way we do the periodic risk assessment also doesn't help that, because it just then creates the perception that operational risk management is something I have to do once a year or once every quarter, when that risk assessment process is triggered. So I had covered sort of various reasons of why we are in the current state, and then we are sharing some ideas during these workshops to address some of these challenges. And that sort of is, the focus is that the ideas we take today. So if you think that, risk assessments are perfect in your organization, then of course, you don't need change. But if you think risk assessments can be improved, then that's where you can take some of the ideas from here, and you'll only find those ideas relevant and useful if you adopt this focus of utilizing risk management as a business management tool to achieve your organization strategy and objective. Because if your objective is that, you want a better report for your board or your risk committee, then you will not get to the effective process, which is what your risk assessment can be. Then what I had started sharing was different practices of what can we change in terms of improving the quality of risk assessments in our organization. So the first one was defining risks at the right level of granularity, where if we define risk at a higher level of granularity, then there are more risk categories rather than actual risks the first line is managing on the day-to-day basis. So if that is the case in your organization, then you may want to consider the granularity at which the risks are defined, because if they are defined at a very high level, then it becomes very difficult to do assessment of any operational risk. And this was also highlighted in the TSB failure analysis, which was done by Slaughter and May, where this was a multi-million change program where TSB was migrating their core banking system from an old to a new system, and it went horribly wrong, where the system was disrupted for 4 to 6 weeks, and for some customers even longer. And when an analysis was done on how they were managing their risks with that change program, one of the findings was that the risks they had on the risk register were very high level. And that sort of then doesn't facilitate when you are defining risk ownership or you're defining controls. If you have very high level risk, then all those become very difficult. And this is the risk register of the TSB project, where there were things like customer and fraud and unclear roles and responsibilities, and most of these are really vague, and some of those are impacts of risk, like cost increases is not a risk, it's an impact of some other risk, and then things like excessive complexity is a cause which would lead to some risk happening. So it's just a mishmash of causes and impacts and topics that are not directly relevant to risks. Then the second practice I had mentioned was that once you've decided to document risk at a particular level of granularity, then you need to ensure that the risks are documented in a consistent way. Because if they're not documented in a consistent way, then when it comes to risk assessment, you may end up assessing the wrong risk, or you may make wrong assumptions when you are assessing those risks. And also connecting the risks to the objectives. Because one of the challenges we had covered in one of the poll was that your first line don't see the benefit of risk assessment. They don't see the benefit because the risks are not connected to the objectives of their business unit, which is what ISO 31000 and COSO ERM, which are the two most widely adopted risk management standard, in the definition of risk, they connect to the objectives. But when Basel created the definition of operational risk, they completely missed that word objectives, due to which most of the risk register are just all the bad things which can happen in the organization, and then not connected to, if they were to happen, which business objectives could get impacted. And that's what first line, they don't come into work every day to manage risk. They come into work every day to manage their objectives, to sell more, to increase the market share, to make sure the online banking system is running. And if we don't link risks to the objectives, then it'll always stay disconnected from the first line. They'll never be able to see the connection on why those risks are important for their business unit. And then I had shared the example of the risk chain tool. So this is the tool. It's similar to the bow tie analysis, where you start on the right-hand side in terms of objectives. So you identify what are the 3-4 key objectives for a given business unit. And then you work out what are the events which may happen, which may result in one or more impacts that would affect the ability to achieve those objectives. And once those events are identified, then on the left-hand side, you figure out the causes, and then each of those causes will emerge from some risk source. So that's where then proactive risk management happens on the left-hand side, on the causes side. And then reactive risk management and business continuity and crisis management, all that happens on the right-hand side of the risk chain. Then I had shared examples of strengthening of GBP versus euro. So this is a market risk example, not an operational risk example, where if that event was to happen, that it may result in positive and negative impacts for an organization, which may then affect certain objectives. And Brexit may be one of the cause of that. And the geopolitical conditions in Europe would be the risk source of that particular cause. And then I had shared a couple of operational risk examples. So in this case, it's unplanned outage of online banking system due to cyber attack, and then the impacts, and then which business objectives would be affected by those impacts. And then on the left-hand side is where you have the causes and the risk source. Here was another example of disruption to customer business processes due to unexpected branch closures. Okay, so I'm not going to go into the detail because it's just a recap, but we'll share the recording in case you missed this session yesterday and you want more details. Then you'll get the recording early next week, where you can hear the details around these topics. And then I had set out some rules that if you want to introduce that consistency, that it doesn't matter who documents the risk in your risk register, when they document the risk title or the name of the risk, we need to have some rules so that all the risks then are documented in a consistent way. And then the rules where that it should be specific to a firm, and whatever you put as in the event should directly result in financial or non-financial impact. So if it doesn't have a direct financial or non-financial impact, then it's most likely a cause of some other risk, but not a risk on its own. And then there were also some rules I had shared on what not to do. So don't put control failures as risk. Don't put actual controls in your risk. And then don't put process failures, because then the risk register will just become a jumble of lots of things. And we only want risks in our risk register and not control failures and causes and impacts into the risk register. Then we had gone through an exercise where we took an objective, and then you had shared lots of examples, and we went through that. And that's where we finished the risk assessment, the risk identification part, and then we started with the assessment part. So in the assessment part, the practice where we ended yesterday was defining appropriate measures to assess risk. So in real life, if I have to assess a distance, then I will use a measuring tape, to do that. If I have to measure liquid, then I'll use a measuring jug to measure that. If I have to measure a weight of something, then I'll use a weighing scale. So similarly, in operational risk, not all operational risks are same. Each operational risk may require a very different set of measures for you to assess compared to other operational risk measures. So in this case, we have 4 operational risks we had looked at, and then we did an exercise where we tried to map each of those operational risks with the different assessment measures, and hopefully that clarified for you that only that not all measures are relevant for all operational risk. Okay. Then when you map those measures on the risk chain, then your likelihood typically, likelihood goes on the left-hand side of the risk chain, because if those causes were to happen all together in some form, then that's where they can increase the likelihood of the event happening. And then you have all the impact related measures, which then sit on the right-hand side of the risk chain. And what happens in most organizations is that we try to consolidate those multiple impacts into 4 to 6 high-level measures like financial, reputational, regulatory. Because in real life, when we've done that analysis for all the key operational risk, if you were to really define all the key impacts, you'll probably end up with between 30 and 50 different types of impacts. They can be financial, reputational, business impacts. But in most organizations, we don't go to that level of granularity. We create high-level measures, so something like this. And then we had done a poll yesterday, which confirmed that most of the organizations on this course are also using something similar, where you have the likelihood as the measure, and then you have the financial, reputational, customer, regulatory, employees, and operational disruption as the high-level measures. And then with each one of those, you may have defined certain drop-down values. So in this case, I've expanded the financial drop-down values to show that very high is anything about 250 million, high is 100 to 250 million, and so on. Okay. And in my experience also, that this is the most common way in which risk assessments of operational risks are done in most organizations. Okay. And that's where we had done the poll. So what I had started doing yesterday was I had started highlighting what are some of the weaknesses in this assessment method, because if this is the most commonly used assessment methods, and we know from our studies that the assessment method is not producing good quality outcome, that it's not telling us what our current risk exposure is, it's not telling us whether our controls are effective or not, we are collecting a lot of poor quality information, then there must be some flaw in this risk assessment approach. And that's where I had shared some of the flaws, which I'll go through, and then I'll talk about how can we address those flaws and improve the quality of our risk assessment. So the first flaw I had shared was that when you create these high-level measures, then you don't know whether the person who's responding to the assessment, which of those detailed financial impacts are they considering. So when they enter a financial impact of 20 million, you don't know whether does that include legal fees? Does that include the compensation we may have to pay to the customer? Does that include regulatory fine, damage to assets, recovery cost? So it becomes very ambiguous if the person who is entering that financial assessment misses out, that he doesn't know what he should include. So he includes some of those, and then people who utilize that information in form of reporting, they may assume that the financial impact actually covers a very different set of risks. And that's where then you get a mismatch of the quality of the information is not very good, and you can't use that information for any real life business purposes. So that becomes one of the biggest quality challenge, or a data quality challenge we have with this risk assessment approach. And I had shared this example from the IBM cost of data breach report, where they analyzed how much do organizations have to spend after a data breach. And these were all the different line items of financial impact they analyzed to calculate the impact of data breach. And what you can do is you can go and check now, whoever is assessing data breach risk in your organization, you can go and ask that person that, okay, which of these line items are they including? And does that align with what the second line is expecting? And does that align with what the people who are utilizing that information expect? So generally you will find that there is a mismatch, that if clear guidance has not been given, then the person who's capturing the assessment may only cover some of these, and then people who are using that information may assume it covers a very different set of financial impact. And that's what generally happens when you try and aggregate, and you then miss out something at the detail level. The second flaw of this approach is that it only allows you to pick one value. But in real life, risks don't appear in one point. Risk appears in ranges. So in case of the IBM example, if there's a breach of 100,000 records, then the average cost of breach is 3.86 million. If the if the number of records which are breached is 1 to 10 million, then the cost is 50 million. And if the more than 50 million records were breached, then the cost is 392 million. And those are just three of the many possible ways in which a risk can happen, a data breach a risk can happen in the organization. But when people are doing the risk assessment with this method, they can only capture one value. And now how do you know whether they're capturing this scenario of 100,000 records? Are they capturing the 1 to 10 million? Are they capturing 50 million? Or are they capturing something completely different? And is that then aligned with the people who are then utilizing that information? And if different risk owners, when they're doing the risk assessment, some people are considering worst case, some people are considering average case, some people are considering minor cases, then you just end up with a mishmash of your risk assessment outcomes. And then you can't use that for anything. Because in real life, from a heat map perspective, data breach may sit in different parts of the heat map, depending on how big that data breach is. Yeah, so that's what I have highlighted on this particular risk heat map. But in real life, when we are assessing our data breach, we just pick one point in that heat map, and that's what we present to the board. And that's just one of the many possible ways in which a data breach can happen in an organization. Then the other flaw we had shared was that generally when we're doing risk assessment, most organizations say, okay, what could be, could this risk happen in the next 12 months? And if it happens, how much money could we lose? Or what could be the financial impact? But in real life, some risks the impacts may unfold over multiple years. So like PPI, LIBOR, are examples like that. And even in the IBM cost of data breach report, they highlighted that 44% of the financial cost of the data breach are spent in the first 12 months, 32% in the second year, and then the remaining in the 2 years after. So this is where, when you're collecting this risk heat map, is the person who's entering the assessment, are they clear that what should they be entering? Should they be entering the whole impact of a data breach, or should they only be entering the impact of what could be lost in the first 12 months after the data breach? And then if there is no guidance, then again, yeah, they may be entering different things, and then we get mishmash of information in our risk assessment reports. Then another flaw of this is that if a risk can happen multiple times during a year, so if there are 3 potential data breaches which can happen within a year, and each data breach, the financial impact is 50 million, then should the person who's doing the assessment capture 50 million, or should they capture 150 million? Because to cover the 3 breaches which could happen in a year. And again, if there is no ambiguity, then you capture, and then you end up with a mishmash in the report. And then for some risks like harassment of employees, discrimination of employees, illness or death of employees, spying of employees by senior executives, that it's just very difficult to utilize these measures or utilize the same risk assessment approaches, because nobody in the business unit is going to say the likelihood of harassment or discrimination in their business unit is medium or high. They're always going to say it's lower. So in this case, it just doesn't make sense. And how would you assess the impact of that, of those risks? Because it can't be quantified. So these are non-financial impacts. So for risks like this, so for risks like these, you need to adopt a slightly different approach. You can't adopt the same approach from a risk assessment perspective you do for risks which have financial impact. And then we'll talk about those examples tomorrow. And then another flaw is the levels that if you have financial and employee scale, and you have defined those different levels, and you're saying high in the financial impact is $100 to $250 million, and then in the employees, high is 25 to 50% of your employees may be impacted. While those scales make sense on their own, they may not make sense when you try to combine them together. Because how do you know that 25 to 50% of the employees, when they're impacted, is equal to 100 to 250 million of financial impact? Yeah. So they may make sense on their own, but they definitely don't make sense when you try and aggregate them. And a lot of organizations then try to take an average, or they take the max or weighted average and try to combine them. And to come up with some sort of final impact they can put on the risk heat map. And then it just introduces a lot more consistencies when you try and combine multiple assessment scales in your assessment. And those are sort of some of the flaws of this approach, which is the most common approach, and most of the organization do that because they want to present this risk heat map to the risk committee and the board, and then the risk heat map, one risk can only be in one likelihood and impact combination, and then if the information you are collecting then is not consistent, then of course the information on the risk heat map is also not consistent. But unfortunately, that's how a lot of organizations do it. And it's not surprising that analysis done by ORX, highlights that this is collecting a lot of poor quality information. So if we need to change, if we need to improve and collect better quality information, then we need to look at how can we improve the risk assessment process. We cannot continue to use the same risk assessment process going forward. Yeah. So that's where then I had ended on this slide, where we need to now look at, okay, what are the other approaches? So if we know what we're using today is not working and you're willing to change, there should be some solution, right? I don't want to just point out the problems. I also want to share that, okay, these are the possible ways in which we can address these problems. And I wanted to share the various resources, which I have come across in the last 3 to 4 years. On how we can improve the quality of risk assessment, but also the quality of how we manage operational risks in financial services organization. So here are some of the resources. If you want to learn more, I'll try and share the ideas from this book today and in tomorrow's session. But of course, there's a lot more ideas still in these resources. So please do look at picking those and then learning from those as you go on that journey. And then if you want to collaborate in that learning, then I'm very happy to collaborate with you and learn together. So that sort of is where we had ended yesterday as a quick recap. So let's look at then how can we change the risk assessment approaches. So one of the methods you can use to change the risk assessment approaches is focus on the key severity measures of your risk. So what are key severity measures? So they are key variables that can influence the severity level of a risk. So this is where you can ask a question to say what variables can change the impact of a risk from few thousand to maybe many millions and many billions, because there'll always be 3-4 key variables around a given risk which can change the severity of the risk from very low to very high. So I want to share some examples of that. So if you were looking at theft of customer data by cyber criminals, then the two most important severity measures are how many records are breached, because more records are breached, the higher the severity, less records are breached, less severity, and also the nature of the information which is breached. So was the breach just of the names and addresses of our customers, or was it also their financial details that the cyber criminals were able to take? How much money they have in their account, how much money they're spending on mortgages and other expenses, or they were also able to access their account access details, so their security questions, their password, so that cyber criminals can then utilize that to access that. So if the nature of the information which is breached is more sensitive and more records are breached, then in that case, the severity of the theft of customer data by cyber criminal risk will be very high. So those two become the key severity measures. So that's the first thing we need to identify, that what are the severity measures, and you don't need to do this every quarter because it's not going to change every quarter. So it's like a one-time exercise where you just need to identify what are the 3 to 4 key variables for each risk, which will define the severity. And I'm giving you a few examples, to help you get started on that thinking process. So for financial statement fraud by senior executives, the severity would be whether the financial statement fraud is happening at the BU level. So is it one particular business unit where they are overestimating revenues or overestimating profits, or is it happening at the group level? Because if it's happening at the BU level, the severity will be less, but if it's happening at the group level, the severity will be much high. and for how many years could that fraud happen. So where the CFO and CEO just cooking the books, for 1 quarter so that they could, publish good results, or have they been cooking books for 3 years and 4 years, which has happened, in many cases. We've had cases where financial statement fraud has lasted for multiple years. So the more years a financial statement fraud can last, the higher the severity of that risk would be. Then if you look at theft of cash from ATMs by criminals, then the severity measures are number of fraud cases, what is the average amount of fraud per case, and how many ATMs can the criminals target. So those three in combination will allow you to do an analysis on assessing the severity of that particular risk. Then if you look at harassment of employees by their senior managers or colleagues, so for assessing this risk, you can in your analysis assume that could this be one-off cases, or could there be a wider cultural issue? So it's not just one person getting harassed, but there's a likelihood that multiple people within a business unit may be target of harassment. So is it a wider cultural issue, or is it a one-off case? And how many employees could get impacted? And the seniority of the individuals who may either be doing the harassment or maybe the target of harassment, because the higher the seniority level of those individuals, the higher the severity of that risk would be. Then for intentional mis-selling of products and services to customers, again, you would be looking at whether, these are one-off cases. So is it just one or two salespeople who could mis-sell products and services, or is it a wider cultural issue where, most of the sales team members are mis-selling products and services to the customers? Again, the seniority of the individuals would be relevant. So the higher up the executives who are involved in mis-selling, the severity is going to be much higher. And then for how many years the mis-selling has been happening. So was it just for 1 quarter to meet the sales target, or is it happening consistently over a long period of time? And how many customers could get impacted by the mis-selling? So those are the 4 variables then which will drive the severity from a few 100,000 to multi-million or multi-billion. Then the last example is illness or death of employees due to pandemic, which is a hot thing at the moment. So that's where you will look at the scale of the pandemic. So that would be one of the drivers of severity, whether it's happening at the city level, state level, country level, or like with COVID, it's happening at the global level. You will look at the R rate. So how many people, if one person gets infected, then how many other people can get infected from that one person. And then the higher the R rate, then the spread is going to be quicker. So the severity is going to be much higher if the R rate is higher. And presence of an effective cure. So is there a cure? Because if there is no cure, then the severity is going to be higher. If there is a cure, then it'll be low. Okay. So those are examples of risks and identifying the various measures which define the severity of that particular risk. So now let's do an example with you. With that, can you help me now identify, and I'll open the chat window here. So on the chat window, can you give me the severity measures of this first risk, damage of assets due to natural disaster? So what would be some of the variables which may change the damage from few 100,000 to many millions? Okay, so sort of one thing that I can summarize from the suggestions we have is definitely the value of the asset. So in this case, if you were looking at the damage of asset, then you need to know that, okay, what is the value of the asset? Because if there was a natural disaster at a data center where we have 20 million worth of IT hardware, then of course the severity is going to be much higher than in another facility, where we just have furniture worth a few thousand. Then in that facility, the severity will be much lower. So value of asset becomes important. Then replacement cost sort of is then dependent on the value. So let's see if there's any other ideas there. Number of BUs affected, cost to repair damage. So cost of repair would then be related to the value of the asset. unavailability of critical services. So, okay, yeah, so we can factor in the duration of disruption. So duration of disruption to customer processes, that would be one, that if that asset, so if a server has been damaged due to earthquake and now the customers are not able to log into their online banking system because of that, then yeah, that would make that the severity of that risk higher. So that the duration of disruption to customer process due to damaged assets. And then yeah, in this case, we're focusing on that the damaged asset scenario. So in this case, yeah, I would ignore the loss of life, because yeah, the loss of life would be another risk. So in this case, this risk is then just focusing on the damage to asset. So we're just looking at the asset part. But of course, yeah, you could have loss of life due to natural disaster. Yeah, would be another risk, which is where you will look at the harm or physical impacts, on your employees. So, okay, so somebody just pointed out the severity of the natural disaster, right? So that also would be a very important. So if it's a big earthquake, then yeah, it could cause much bigger damage than if it's a small earthquake. Similarly, if it's a big flooding, it will cause much more damage than, a small severity flooding. So I think that's a very important variable to consider. Okay, so let's then go with those three for that particular risk. Then can you help me with the risks on the right here? So now if we were assessing a risk of external parties, they utilize our products and services for money laundering. So what would be some of the severity measures which will change the severity of this risk from a few 100,000 to many million? Okay. So so we have one good suggestion. Yeah, so number of years suspicious transactions may go undetected. So yeah, that would be one that we've had cases where for 6-7 years because of IT system issues, organizations were not capturing enough suspicious transactions. So yeah, if that happens for multiple years, then definitely the severity will be much higher. There's one suggestion on number and value of transactions. So that's where I can use that to say number of transactions by high risk customers. Because we don't want to necessarily put all our customers in that category, right? So most organizations then do like a risk analysis of their customers. So if we know that there are certain politicians or there are certain people with public influence or with connections to political parties or certain organizations which are suspicious, then we would flag those customers. So how many transactions are we getting from those high risk customers? And then the value of transactions can also be another driver by high risk customers. So the size of the fine, okay, yeah, so we could put the size of the regulatory fine, because there are some regulators, like in the US where the level of fine is generally higher than in other jurisdiction. So that can also become a factor in terms of jurisdiction, which can increase the severity of that particular risk. We have 4, so let's go with those 4. So you've identified the measures then which will define the severity. And this is a one-time exercise. So once you've done this with the first line, and you will be able to do this easily with the first line, because this is nothing here is related to risk management. This is all first line concept that if you talk to the right people in the first line, they'll be easily able to give you 3 to 5 severity measures which are related to the risks they're managing on the day-to-day basis. So if we understand that, then the second sort of concept I want to introduce is looking at the likelihood from two perspectives. So I think normally in operational risk, we just look at likelihood from one perspective, but there are two perspectives we need to consider. And this is what ISO 31000 talks about, and Norman Marks also talks about in his book, World Class Risk Management. And we can benefit from using this concept for operational risk. So one sort of example I wanted to use was a personal example where you can say that involvement in a car accident on a motorway, so the likelihood of somebody being involved in a car accident on motorway is, let's say, 1 to 5%. Yeah, so that's the likelihood that they would be involved in an accident. But then if that event was to happen, so if that risk was to happen, then there are multiple impacts which may happen. So one impact maybe there may be minor injuries for people who are then involved in that accident. And then the likelihood of that is 80%. So if there is an accident, then the likelihood of minor injury is 80%. The second impact may be the major injuries, that you have to be taken to the hospital and into emergency and so on. And you would say the likelihood of that in this example is 15%. And the third impact is loss of life, where in this case, the likelihood is 5%. Yeah. So I want you to look at and understand the separation, because if you don't understand the separation, then what I'm going to share next will not make sense. That the likelihood of the risk event is very different to the likelihood of the impacts. Yeah, so likelihood is 1 to 5%, but then the likelihood of the impact only matters if that event was to happen. Yeah, so only then the likelihood is 80% of a minor injury and 15% and so on. So in this case, you're looking at two likelihoods. So on the left-hand side, you're looking at the likelihood of the risk event, which is telling you everything about the causes. So what is the likelihood that if we drive on a motorway, we would get involved in an accident? And the likelihood of the impact is telling you only if we are involved in an accident, then what is the likelihood of us suffering with those impacts? Yeah, so the likelihood of impact is after the event. So if that makes sense, then let's use that example from an operational risk perspective. So now if we look at theft of customer data by cyber criminals, which is an operational risk, and we've identified that the two severity measures are number of records which may be breached and the nature of information which may be breached as part of the data breach incident. So how do we now utilize those severity measures? So in this case, we are saying, we're breaking down the impact of the risk. And then, yeah, this is relevant for financial impact, where you're breaking down into minor, moderate, major, and catastrophic. So now we're not doing 1 point. So when you put on the heat map, you're just looking at 1 point. So what we're saying now is that we don't want to just restrict our analysis to 1 point. We want to look at a little broader range. And in this case, the recommendation is to at least look at the 4 ranges. And then in the next, there's another practice here when we look at the Monte Carlo simulation, you can look at thousands of ranges. But in this case, we're extending from capturing 1 input to 4 inputs. So we say that what is the likelihood of theft of customer data by cyber criminals happening in our organization? So in this case, the likelihood of the risk is 99.99% because it's the left-hand side, because every organization is being targeted by those phishing emails that hundreds and thousands of employees are getting those emails. So the likelihood that we have to deal with that cyber risk is very high. And that's why cyber risk becomes one of these things where you just need to have a lot of good preventative controls, because the likelihood of cyber criminals targeting your organization is 99.99%. So there is almost a guarantee that every employee will get 1 phishing email every day. So that's the likelihood of the event happening. Then we're looking at, okay, if that event happens and if the breach is successful, then what do we do? Then what is the impact on our organization? So in that case, you're saying then minor impact is where less than 100 records may be breached. So this is where now I'm providing some context that if there was a minor breach, less than 100 records will be breached, only the personal details will be breached, and all the impacts will be paid out immediately. So that impact is not going to last over a multiple 12-month period. And what we're saying is based on what we know about our business and data breach incidents which have happened in our organization, data breach incidents which have happened in other organizations and studies which we have reviewed, that's going to happen 60% of the time. So after the cyber criminals are able to successfully breach, then 60% of the time we will suffer with this impact, because then our detective controls will kick in, and if the controls are working, then we will stop them before they try and steal a lot of data that will block their access if they were able to, if they were successful in starting to download or starting to copy the data. And in that case, we are estimating that the financial impact for us may be between 10,000 and 100,000 pounds. And on the left-hand side is we're then highlighting which costs are included, because we don't want to leave any ambiguity. We want to be very clear that that 10 to 100,000 covers what sort of costs. So we've sort of highlighted, that it covers forensics, legal fees, credit monitoring services, and so on. So in this case, there is a 60% likelihood that if a breach was successful, this is the impact we will have to deal with. Then it always makes sense to go from minor to the catastrophic. So that's why I've sort of done that two analysis first, to say that, okay, what is the worst case which could happen? So in this case, if we then don't have good recovery controls and we don't have good detective controls, where cyber criminals were able to get into our system and they were able to then download all the records, and let's say it takes half an hour for them to do that. And because we didn't have good detective controls, they were able to download the 10, 50 million records. So in that case, we're saying that that would only happen 5% of the time. And again, you're making that assumption based on how good your controls are. Because if your controls are not good, then of course that percentage would be much higher. And then in this case, we're saying 50% of the impacts we've highlighted here will be experienced in the first 12 months, 30% in year 2, and 20% in year 3. And then the range we are saying, again, so all this is your manual input. So we're still collecting this data, it's still subjective input, but we are putting a little bit more structure, that it's not just a selection from a drop down. There's a little bit of thinking going on, and everybody can easily see, okay, what has been included, what has been excluded, so that there is no ambiguity on the outcomes or the information we are collecting here. So in this case, we're saying in a catastrophic event where our preventative controls didn't work, detective controls didn't work, responsive controls didn't work, then that's the sort of financial impact based on what we know about this risk in our organization and in other organization we may have to be ready to face with. And then once you've done that, then you can do the moderate and the major and then fill out those other ranges to say that, okay, what if then it was a little bit more severe than minor? And then you say that, okay, the likelihood of that is 20%. And then that's where between 100 and 100,000 records may be breached. That's where personal and some financial information may be breached. And then 40% of that would be paid in the first 12 months, 30% in year 2, and 30% in year 3. And then the impact is 100,000 to 5 million. And then you say with a major, the likelihood is 15% that would happen. And between 100,000 and 10 million records, personal and financial details, and then the breakdown over which we would have to pay that impact. Yeah. So that's the alternative approach to doing how we do risk assessments at the moment. Yeah, where we just pick one drop down and then we don't know. We're just collecting one possible way in which that risk can happen, and we don't know what has been included and excluded from that. Let's do another example of intentional mis-selling of products and services to clients. So in this case, we're saying that the likelihood of this risk is 5%. So we are saying that, yeah, majority of our salespeople are great. Yes, there may be a few sales. So if we have 1,000 salespeople, so there may be 5% of those salespeople, yeah, maybe malicious, and they may be trying to mis-sell products and services to the customers. So in this case, we'll say the likelihood of a salesperson mis-selling is 5%. And then if that mis-selling event does happen, then you are looking at the impact. So then you're looking at that the minor case is where mis-selling is covering less than 25 customers and only 1 to 5 sales team members are involved. And this mis-selling then occurs in a very specific part of a business unit. So it's not happening all over retail banking, maybe only in a personal loans division of that retail banking is where there are 2 or 3 salespeople who've been involved in mis-selling. And this occurs over a 3-month period, and there are no senior executives involved. So it was just the sales, it was either just one salesperson or 2 or 3 salespeople. And then the likelihood of that happening based on our existing controls we have. So that's where this likelihood of impact is then addressing whether we have good controls to discourage our salespeople from mis-selling. And if they do, then do we have controls to detect that so we can find out and then quickly stop the impact? So in this case, we're saying that 70% of the time, this is what would happen if a salesperson does go and mis-sell products and services. And then we may have to pay between 10,000 and 500,000 pounds. And in this case, that covers the compensation we may have to pay customers and the regulatory fine we may have to pay. And then the moderate scenario is where mis-selling is between 26 and 1,000 customers may be involved. And again, yeah, you'll need to change those numbers, whether depending on corporate or individual customers. And in this case, 6 to 50 sales team members would be involved in the mis-selling. It occurs across one significant business unit. So if retail banking is one of your business unit, then it's happening across multiple parts of the retail bank. So it's not just one part of retail bank. And mis-selling is happening over 6 months, and there are some senior executives involved in this case from that particular business unit. Then you have the major case where you're saying mis-selling is covering 1,000 to 1 million customers, 51 to 250 sales team members involved. And the mis-selling is happening across, still one significant business unit. Mis-selling happens for 1 to 2 years. So that's mean our controls were not really effective in that case, because if mis-selling was happening for 1 to 2 years and we were not able to detect that, then that sort of highlights their weakness in our control environment. And in this case, there were 4 to 10 senior executives involved. And then we're saying the likelihood of that happening is 5% in our organization. But if that was to happen, then here is the range of financial impact we have to be ready to deal with. And then the catastrophic is where you're saying mis-selling covering 1 million to 10 million customers, and then more than 250 sales team members are involved. And then mis-selling is happening across multiple business units. So it's not just one business unit, and it occurs over 3+ years, and 11 to 50 senior executives would be involved. And sort of this happened at Wells Fargo, for example, where there were many senior executives, many sales team members, where they opened up multiple fictitious customer accounts to reach their sales target. But in this case, for the organization, we're saying in our organization, it'll only happen 1% of the time. So it can happen, but we have to then make sure that our controls are effective. So we don't, so that doesn't become reality, because we're trying to look at what may happen in the future when we're doing the risk assessment. Let me check. There was something on the chat. So if there's any questions, then this is the time. So how are the variables defined? Expert judgment, or is there some regulatory guidance to define the variables? Okay, so those scenarios, well, so in this case, what you are accepting is that the risk will not happen in one point, right? So that sort of is just one reality, that risk happens in a range. So if risk happens in a range, so now you need to assess risk as a range. And then the question is, you can assess 2 ranges, you can assess 3 ranges, you can assess 5, you can assess 10. So you need to decide, depending on the reporting you want to do, how many do you want to cover? So based on the guidance I have read so far, at least 4 will give you an idea, or at least you want to do 3 to 4, because 2 will then not give you a really enough coverage in terms of all the possibilities. So the examples I have seen so far, 4 seems to give you a good coverage. But if you can't do 4, at least do 3. Then you sort of cover your best case. In this case, there's no best case scenarios. There's like a low severity scenario, medium severity, and high severity, that at least do 3. But in that case, when you do 3, a lot of things will then get into that middle scenario. And that's why I like to do even numbers, because if you do that even numbers, then you can break that middle part into something more sensible, because the moderate and major, there is a significant level of difference between that. So that's where, Pamela, you asked that question. Based on that guidance, 4 is what I would recommend as what I have seen. But there's no regulatory, I don't think regulators, I haven't seen any regulators saying you need to do 4. So Nibila is asking about the insurance cover. So this is where insurance cover is normally, you don't consider insurance cover in your residual risk assessment. So here we are looking at a residual risk assessment. But that's where, if the methodology was that, okay, we have a certain amount of insurance cover, then you would just reduce that amount if you want to incorporate. But ideally, insurance cover is not factored in the residual risk assessment. So you do your residual risk assessment independent of the insurance. Yeah. So in this case, it's more about assessing the effectiveness of the control environment, because now if that catastrophic scenario was a 10% likelihood, then it tells you something about the control environment in your organization. So all of this is then based on input, but all of this is business input. So none of this is risk, because how many customers are involved, how many sales team members are involved, none of this is risk language. So all of this is business language in terms of, okay, how much customer compensation we may have to pay, how much regulatory fine we may have to pay, how many senior executives may be involved. So we're trying to sort of bring this as close to as close to first line as possible. Tin is asking about, what are we assessing? Residual risk. So I am not a big fan of inherent risk. So in this case, it is definitely only residual risk, because that's also one of the issues with why first line don't like risk assessment, is because, first of all, we send them all of these risks for risk assessment, and then for each risk, they have to assess inherent and residual risk. So we're sort of doubling the amount of mental effort they have to spend. And generally, it's not giving good quality. It's not giving good quality outcome. So my recommendation is, not to do inherent risk assessment, is to only do residual risk assessment, because that is the current state based on your current control environment. That is what matters. But we'll talk a little bit more about inherent risk assessment tomorrow. Okay, so let me then come to this one. So this is a second sort of method that if you want to then go a little bit more granular, and you need to decide that for which risks you're doing this, right? So so if the risk is really important, then you want to spend a little bit more time analyzing that risk and the exposure. If it's not a very important risk, then you don't want to spend all this time on very little petty type of risks. So you need to decide for which risk this level of effort is required. So another model which then goes a little bit more granular, if you wanted to go beyond that 4 range we talked about, is where you identify the different risk drivers. So in this case, we're saying, how many customer records do we have? We have 5.2 million. Then what is the cost of sending email communication? That if there was a data breach, then we're saying there's 25 pence. What is the cost of a call center staff? That if there was a data breach and we have to hire extra call center staff to deal with the data breach, then we have to pay £140 per call center staff every day. Then if there was a big data breach, then we may have to sort of apologize to our customers. So we may have to buy an ad in Financial Times. So you're saying that, okay, you may have to pay £20,000 for that Financial Times ad. If you have to provide credit scoring facility to your customers, then that's what costs £10 per customer to provide that facility. The average cost of cybersecurity staff per day is £400. Average cost per hour of senior executives who may have to then deal with a crisis related to data breach is £300. Average compensation you may have to pay per customer is £250. Potential average revenue per customer, because if there's a breach and you lose your customers, then you lose the revenue you would have got from those customers. So in this case, we're saying, £300 is the revenue we're getting per customer. And what is the revenue of the preceding financial year? Because that's where, if it's a data breach and GDPR rules were used to fine, then it'll be percentage of your annual revenue of the preceding year. So this is where then you're identifying a few more drivers on what drivers would then impact the severity of a particular data breach. So you do that first, and then you can model in a spreadsheet. So you can say that, okay, if 1% of the records were breached, which means then it's 52,000. So that's 52,000 of that 5.2 million. And then if you have to send 3 email communication to the customers, then sending those email communication is going to cost you 39,000 pounds. How many man days of extra call center staff do you need to respond to that data breach? So if we say 20, then that becomes the cost of that call center staff. In this case, we may not put an ad in Financial Times. We may provide credit scoring facility to those customers. In this case, there are 52,000 customers. So the cost of offering credit score facility then is 520,000. Number of man days of cybersecurity staff to deal with the breach, because now they're not doing the daily job, they're just responding to the crisis. So now you're saying that they may have to spend 20 days trying to respond to that data breach, and that cost of that is going to be 8,000 pounds. How many senior executive hours may be involved? So that's 30,000 pounds. Compensation we may have to pay to the customers is 13 million. And how many customers we may lose after that particular data breach. So we're saying 0.05%. So you may lose 2,600 customers. So that the 2.3 million then becomes your lost revenue. And then the potential GDPR fine, which is then 4% of that 700 million revenue, then is 28 million. And then you can sort of add up these impacts to say that if all of these impacts then were to materialize, and if we lose 1% of our customer data, then that's where the total financial impact is 43.9 million. And then once you have that model defined, then you just change the percentage. So if you want to see what the financial impact could be for 5% or 10% or 50%, then you just get a little bit more granularity in terms of your risk assessment, rather than a very high level subjective figure, which the person who's entering is not clear, the person who is reviewing that is not clear. Yeah. So this is where, only if a risk is really important and you really want to understand the financial impact, so you know that you have enough capital, you're prepared to deal with that risk if that was to happen. Yeah. And that's where we're talking about these two approaches, that the approaches we use currently of just one drop down to create the heat map, it's ambiguous, it only covers one possible range of risk. And it's very difficult then for second line and third line to challenge the first line if you just get that one drop down and there's no clarity on that. But if we are doing assessment of risk this way, then there's a lot more clarity. It is covering many possible range of risk. So we know what could be the potential impact on the organization in many cases, not just one case. And it becomes very easy to challenge, because once you have this, then the second line can challenge. So why are you assuming we only have to pay £250 compensation to customers? Because this happened at Barclays and they actually had to pay £500 compensation. Then you can at least have some discussion if you have that information around the model open, because then everybody can brainstorm, challenge, and then agree what would be the right set of levels we can estimate, so we can get a good idea. And of course, you will never get accurate, right? So that we're not looking here for accuracy. We're trying to get rough ballparks so that we are prepared to deal with those risk events. And then from a risk management perspective, we want to focus on the controls and making sure we have capital and all that to deal in case the worst was to happen. Okay, so those are sort of the two approaches so far. And then the benefits of those approaches is that, they do require significant effort. So, the first reaction I get is, oh, Manoj, if my first line people, they're not even giving me one drop down, there's no way they're going to, do all this thinking. Yeah, of course, they are not going to do. So this is why it needs to be a collective exercise where your second line will need to facilitate that, because you only need to do this exercise once. Because once you have created this model, now you don't have to go and assess this every quarter, because the range of the risk is not going to change every quarter. What will change every quarter is maybe your controls have become less effective, or there are incidents which are happening. So there are other factors is what you will need to then focus on. But once you capture this type of information, then you don't need to go and update this at this level of granularity every quarter. So maybe it can be reviewed once a year, but that range doesn't change, that quickly, unless there is a big acquisition which happens, and then all those numbers have doubled, then of course, yeah, you may have to go and look at that model. So yes, it takes a little bit of effort initially, but if you focus on the business language, because that's where these approaches, they're using that business language. Okay, how many salespeople are involved? How many senior executives may be involved? How many customers may be impacted? And all that is first line. There is no risk language we are using in that context. So we try and use as many business terms as possible. And then you may have to guide, because yeah, the first line, they may not, they may know what those numbers are, but we'll need to give them some structure. So that's where second line needs to create that structure and then do those workshops to be able to bring those measures out and bring those ranges of the values for those measures. But once they are in place, then you'll be in a good place in terms of understanding your risk exposure compared to the current methods we use. And then they can be easily utilized for real life business situations, because now once I have that range, I can then utilize that when I'm making an outsourcing decision, or I'm making a decision to appoint a new intermediary to sell our products. I can look at those numbers and try and sort of see whether we will stay in that ballpark or not. They make it easy for second line and third line to challenge, because there's so much clarity, there's so much detail, rather than just one drop down value. It becomes much easier for second line and third line to see whether first line really understands the risk they're assessing, or they just, it's a wild guess. That using these approaches will make it both for it is easy for the first line, but it's also easy for the second and third line. And then if you don't want to do this, yeah, for all the risks, so if you have 100, 120 risks on your operational risk register, you probably only need to do this for 10, 15 of your most important risks. And then for all the other risks, you can continue doing the drop-down approach, because if accuracy then is not that relevant, then you don't have to do that for all the risks. But at least for important risks, you want to make sure there is this level of granularity, because if you don't have that level of granularity, then who knows whether we are doing the right things or not in terms of managing those risks at the moment. So with that, let me then introduce another practice. So to introduce Monte Carlo simulation. So this is where, if you wanted to go further, so we have currently, are we using those drop-down values where you get one range. The next step sort of increment would be you go from one range to at least 3 to 4 ranges. And then if you're ready to go beyond that, because again, risk will not just happen in those 3 to 4 ranges, right? In real life, risk is happening in all the colors of gray. It's not black and white, it's all the shades of gray in the middle. And that's where, if you want to then improve the accuracy of your risk assessment further, then that's where you can use Monte Carlo simulations. And that's where I am bringing in Dr. Mustafa into the discussion, because I don't know a lot about Monte Carlo, but this is something I'm very interested in learning, because Monte Carlo, traditionally, it has required you to be a statistician in order to use Monte Carlo tools. But over the last 3 to 5 years, because of all the technology which has become easy, now there are a lot of easy tools which are available where first line can also use Monte Carlo simulation, and you don't need to be a statistician to do that. And I wanted to share some example, because this is where you can really dramatically improve the accuracy of understanding the risk and your risk assessment. So what I want to do is, let me share the access with Mustafa, and he will then take us through, and I've given him a brief to start with the basics that assume that we don't know anything about Monte Carlo, because I'm also a student of Monte Carlo, so I'll also be learning, and then I'll just interact with him as he presents his examples.
In terms of decision making, so far everyone made it simple, really. We said we want to assume there's no uncertainty. There's, whatever we estimate from a cyber breach, a data scenario, is fixed number, and as your examples before, the cost to the business, the loss is not a fixed number. It depends really on the number of customer data loss and the number of percentage of data itself, and the cost of postage, cost of telephone sales and marketing, all that. So it's really a variable. The same thing also happens in terms of other dimensions, such as the impact itself is not fixed, because there is only limited knowledge and historical data, as much as as far as the experience, actual observed data. And often control environments change and systems change. Hence, the data we have in the past is not very relevant. Hence, there's a lot of expert judgment involved, which means the data is still subjective. It doesn't matter how much objectivity we bring in, there's still a lot of subjectivity left. So hence, we need a methodology to go from an assumption or from made assumptions, subjective assessments, to outputs. And one model often used for any decision making is the normal model. So basically, this is, I'm not sure whether you can see my slides, but
yes,
you see here US female heights, and I think this is like the whole population. And as you can see, this is a normal bell-shaped curve, which everyone, I'm sure, sort of has used and understands, just to make the introduction to scenarios and uncertainty as well as modeling. Basically, this is itself a model. It says 6 to 8% of US females are between 5'9" and 5'6". And only 13.5% of US females are between 5.5 and 5'11". And only 2.35% are above 5'11" and up to 6.5. And there's even, you can see this curves goes further. So basically, this describes the natural phenomena like height, weight, and what else? I mean, all the things like even the animals and their lifetimes, their behaviors, even human, or overall or body sizes, and so on. So as you can see, this already has a probability attached to a certain value. So when we say 2.35% of the US female are between 5'11" and 6.5, we already assign a value. So this is already using a so-called normal distribution model to make a prediction. So basically, if I go and randomly select a person in the US and say, okay, let's measure your size, and this model will tell you with a certain confidence how tall this person is going to be. So basically, there is then less than 1% chance that the person I randomly select is going to be above 6.5 or below 5.3 inches. So basically, so this is a normal distribution model everyone understands and can relate to, but it has problems. Basically, losses from operational risk events are not normally distributed, and this is a very simple in sort of to understand that the losses are bounded by 0. There's no negative losses, and there's no upper bound. As we've seen from losses, they can be beyond what we have so far seen. They can bring down banks, they can bring down even countries. So basically, there is no upper limit, but they still need a model to be described. So continuing from your slides, from minor, moderate, major, catastrophic. So if we try to place your 4 buckets, I call them buckets, the minor to catastrophic buckets. Minor to moderate would, and as you said, is like be somewhere between 41 and and 99%. So basically, this is the most likely sort of place where it would fit. Minor to moderate would be this mid range, and catastrophic would be on towards the right hand scale. If we put this normal model to impact and likelihood. In fact, the impact bit is a loss from financial impact from an operational risk event, and the likelihood is nothing more than attaching this probability. So basically, your probabilities here, these from the in your example, and as well as the from the US female heights, they have one common thing. They assign a probability to an impact.
Mm-hmm.
So in terms of putting this to a opera's context, that's where communality ends. So basically, the normal model is not a good model to explain the distribution of losses. And in fact, the BIS, the International Bank for Settlements, as well as other sort of EBA and FCA and so on, they all assume the log normal model is a better, in fact, is one of the few models which is accepted commonly and used commonly across financial institutions to describe the loss distribution. So basically, and then this way you can put the minor and moderate towards most likely values, more probable values, and the catastrophic and major and catastrophic to the right of that. This way, you have a much better description of the losses, impacts, financial sort of cash flow outage, cash flows I need to put aside from operational losses, from operational risk events.
Yeah. So the key point here, Mustafa, then is that operational risks, they don't happen in the normal curve way. That this is the more likely way in which operational risks happen.
Yes.
Majority of them are in
Absolutely.
the left.
I mean, absolutely. This is, I think, the key thing. So I've modeled all types of operational events and losses from them. So basically looked at lots of historical data,
Mm-hmm.
across various categories like EDPM, execution delivery process management, customer products, business process management, the Basel II types like internal fraud, external fraud, and so on. And they all look like a log normal model. So any log normal model can be, so when I say any, so a log normal model can be fit to any operational loss distribution, actual losses I see, the actual distribution of losses I see. Okay. So in that sense, the only thing is for different type of course, categories, you need a different calibration, but it's the same model. It's just screwed differently, as well as it's dialed differently. It's stretched more to the right or left, and it's the minor bit is more to the right or slightly more to the left, but it all is described by a simple log normal model.
Okay.
So, and basically, when we have, and in fact, it goes further. Basically, even in your case, when you said minor, moderate, major, catastrophic, in your mind, you have started with a point like minor, and you went to catastrophic, and you filled the rest, didn't you? You later on you put moderate and major to it.
Yeah.
So in that sense, what you've done is you've got minor and catastrophic, and you filled between. So between. So if you think of minor and catastrophic being two buckets, you put another two buckets. In Monte Carlo, what's happening is, that's really interesting, and the analogy to what you're doing, Manoj, is you, instead of 4 buckets, you make up to 200 or maybe few hundred, like maybe around 200 or up to 1,000 buckets, but each list of buckets are filled through Monte Carlo sort of simulation mechanics through so-called random numbers. But random numbers are using all the time the log normal distribution to say which random number or which buckets is going to fill with which sort of frequency. In that sense, a Monte Carlo is nothing more than filling the buckets beyond your input. So basically, if your subject matter expertise is catastrophic, is here 50 million or 5 million, and your minor is here 10 or 100,000, this is enough for a model to take that information and interpolate between, as you have interpolated between minor, moderate, and major. So you've done these 2 further, but you can even go beyond. You see, your catastrophic number is based on your subject matter expertise. You don't have 200 years of data to back this up. So the only thing you have is a few years of data, maybe 10 years, but you don't, what you want to do is you even want to extrapolate beyond catastrophic of 10% likelihood, but you want to do it up to maybe 1 in 1,000. But you still have a robust methodology because you already have a range, an idea of points on your curve.
Mm-hmm. Sure. Okay.
So basically, if we continue with the next slide. So what we are doing is really, we are filling, we are making this inputs, your 2 buckets to hundreds of buckets, and we use the Monte Carlo simulation for that.
Right.
And that's really nothing more than that. So what we are then doing is, and we don't have historical data, and often historical data is quite outdated often because it relates to historical control environment, which you may have fixed already the control environment. So basically your loss sizes may relate to a weaker control environment. Now you've fixed it already. So how will you sort of cater for that? So in that sense, you still need subject matter expertise to come up with your estimation of extreme but plausible loss, or what I call extreme but plausible loss. In your case, you use catastrophic loss. So, and because now you can make some assumptions. One assumption we said it's log normal distributed. So this is backed by banks, and they agree with that. And second assumption we are doing is, when you have an average of 20 years of experience and relevant experience in your expert team, then what the 20-year experience relates to a 95% confidence level, meaning 1 divided by 20 is 5%, 1 minus 20, minus 1 minus 5% is then 95%. So this is, again, another second assumption which the regulators agree with and don't disagree with that assumption. So in that sense, what you do is you use, in that sense, the log normal curve as an impact or financial loss occurring every time you observe an event, successful event like the data loss happening in your organization.
Okay, Mustafa, you've gone in your expert mode now. I have lost
you. That's basically, this is what we do. So basically, we'll just go straight to examples.
Okay.
Basically, let's
get
do
an example. Yeah. So try and understand. Okay. All right.
Here's the two information I need. One is the extreme but plausible loss.
Okay.
From your data loss exercise.
Mm-hmm.
And then a more moderate one, typical, i.e. this is the tip of the curve, the most likely value I'm going to experience rather than extreme.
Right.
Yeah. And because I'm looking at scenarios and risks which don't occur year on year, and because cyber attacks happen all the time, but how many of them result in a sizable loss? Or, often maybe it's an outage for 10 minutes or 15 minutes, a cyber event, but that doesn't lead to an actual loss. So basically, if you think of some threshold, so above threshold, then there's only 5% chance of that type of major event occurring. 5% of successful event, so leading to a loss of data and leading to all this cost.
Right.
So in that sense, I've got 3 things, 3 inputs. 5% likelihood of that occurring. The 10 million is the extreme but plausible subject matter expertise, and the typical loss. That's it. So, and you don't, and all the assumptions are made in the background.
Mm-hmm. Okay. So that 5% is representing, the cyber attack happening all the time, but that 5% is only representing the ones where our controls failed and cyber criminals were able to get into our system and steal data.
Absolutely. And in that sense, then let's say we do 10,000 iterations. In Excel, you can do 10,000, you can do 1 million. So, let's say, trial 1, it hasn't occurred. So meaning your trial, what you are doing, as of now, you are saying for as of now, I want to estimate the potential losses within 12-month horizon.
Mhm.
Meaning, so you model 10,000 times the next 12 months.
Right. And this is what Monte Carlo will do, right? So I, as a first line user, all I need to do is give that 3 input. So I need to provide, okay, what is a typical financial impact for that risk?
Yes.
The extreme but plausible loss, and what is the likelihood of that risk happening where there would be an impact. So I'm only
Yes.
giving that input, and then the table below is where now Monte Carlo will start doing the
Yes.
work.
Absolutely. So
Okay.
basically when then, you know, a random number generator will tell you has it occurred or not. So basically the second trial is not successful, but third trial is successful. So basically from the 10,000 trials, I expect, you know, by 5% likelihood, 500 to be successful. I'm going to see 500 ones and 9,500 zeros. And every time there's a one, either it's occurred, then I'm using now the log norm model and then saying, okay, the log norm model is the one I'm using. So basically 10 million an extreme and the 100,000 the typical. But now I'm using another random number to say within this curve, give me a random number. So assign a number randomly, but use the log norm model, but using my 10 million and 100,000 assumptions.
Right.
So in that sense, I am creating events, but they're not sort of impacts, but they're not random. They are now driven through my assumptions.
Yeah. So in this case, then what if we were looking at that data breach example? So the first trial is a data breach, but in this case, let's say our controls worked. So
zero
there is no
impact. Yeah.
The second one is another data breach where again our controls worked, so it didn't happen. And the third one is where our controls failed. So a breach happened, and
yes.
In this case, yeah, it was a small breach, so we would only, in that example, lose 2,420 pounds would be
Yes.
the impact. And then from 4 to 11 are other breaches where there is no impact. And the 12th one,
another breach.
209.
So
Okay.
they occur randomly. So you don't know, you know, these 500 events, which I'm expecting over the 1 year horizon, over the forward-looking 1 year horizon. I don't know where they are. They are distributed randomly, and also whenever they are called, they are distributed randomly, but using my assumptions of 10 million and 100. Basically, the 10 million and 100,000 inputs are deriving my curve fitting. So there's a curve fitting happening in the middle, but you don't need to worry about that. So basically, as long as I know the 10 million is 95% of the log normal curve, which it is.
Yeah. Yeah. So Nimrala is asking a question on, where do we get the occurrence? So that is, if you have historical data, then you can get it from historical data.
But
for
often
a lot
it's
of
all
we will
subject
not.
matter expertise. You see, often the IBM Horizon, Verizon data, and as well as other sort of experts will tell you sort of about the average chance of observing or having a major data breach in your organization, because they have some historical data looking at similar organizations. But in your case, you may have a different control environment. You may have very, very different business model. You may have optimized everything, and there may be, there's no way of actually having that 5%. Maybe it's, in your case, it's 1%. It's really subjective, but still you can actually validate your estimations and subjective assessment, because you can say, look, run the analysis now next time with with, let's say, 4%. What's happening? So basically, then you run it again, but you get that again from a runner with random numbers and Monte Carlo. You get another potential loss, and so on. So you see the sensitivity of sort of to your assumptions. So I'm not doing this in Excel, but you can do it with a proper Monte Carlo engine.
Yeah. And I'll just address one question from Stefan also. So yes, yeah, those three inputs, Stefan, are still based on expert judgment.
Yes.
But there are tools to make sure that it's not a wild guess. And that's where we can talk about that here tomorrow. But in the Douglas Hubbard book of How to Measure Anything, that's where he talks about a very detailed technique of how do you make sure you ensure the quality of your expert judgment, because yeah, you can't go to anybody in the first line
Yes.
and get that data, because you need to go to the right people. And that's where the book Super Forecasting also focuses on that okay, who are the right people who can give you good quality subjective judgment, because you can't go to anybody, for
Yeah, I
that.
mean,
Be very
ab-
select.
absolutely. But what you have to do is you have to understand the sensitivity of the model to its driver. So what is driving this model? It's very simple. The biggest driver is the extreme but plausible loss. So it's not linear, but actually every time when you change from 10 million to 9 or 8, whatever, whenever, or increase it, your potential loss at the 99.5%, i.e. potential losses uh, from the 10,000, the 9,950 of the trials will be not bigger than that number. So you can actually sort of run very sort of like sort of changes your assumption and see how sensitive it is. And you will see that the extreme but plausible loss, or your here catastrophic one, drives the number, of course, drive your potential loss in 99.5% of the trials. But likelihood, when you increase from 5 to 10 or from 10 to 20, it's not a linear, but it's much more concave. Maybe I can show you maybe later on some sort of examples of that as well. So your assumptions are driving your potential loss in 99.5% of the trials. So yes, but at the same time they're logical, so you understand how the model is operating. So basically, it's not really a black box. That's what I'm trying to say. So you understand the inputs, you understand the model in the middle, you understand the random number generation as simple as it is. In this case, really, it's nothing more than that. And therefore, you only need to worry about making sure that your inputs are in a way much more robust. So
Yeah.
garbage in, garbage out applies here as well.
Yeah, absolutely. And the way you can make sure it's good quality is by documenting the assumptions, because
Absolutely.
against behind those numbers, there should be some assumptions. And then that's where a first line documents that, then second line can challenge those assumptions. But at least, yeah, you have that basis. You're not just sort of relying on these numbers. It's more important is the thought process which has happened before you came to this number. That's what you want to make sure that the risk owner or the person who's doing the risk assessment, have they done the thinking about the risk? That's what we're trying to get them to do, right? We want them to think about the risk rather than, half an hour before the assessment is due, just randomly and
yes.
provide
Yes.
assessment responses.
I mean, you see, the beautiful thing about about any model is actually once you have a methodology which is robust, and you can actually then play with the inputs. You see, if we change in this case, from the 10 million to the 5 million, the extreme but plausible loss, what's happening is now, even the same random numbers apply. Now the impact whenever the event occurs is slow, is a smaller number, because my curve is now flatter now. My curve is not as fat-tailed. It is actually less fat-tailed. Hence, your numbers now, look at the trial number 3 and 12, they are actually much smaller numbers.
Yeah. So let's complete that example, Mustafa. So it's happening, the 10,000 times. So it's going through that iteration, and that's where sort of what Monte Carlo is good at, right? Because as a human mind, it'll be difficult for us to, maybe we can create 3 or 4 buckets, but it'll be difficult for us to create lots of trials. So that's where Monte Carlo really adds value, that it can go through that process. So it can mimic 10,000 potential cyber attacks, and then based on the input you have provided, it can, based on the likelihood, it can say that, okay, 5% of those would be successful, and those for 5%, it's creating a log normal financial impact for you. And And then what are the outputs then on the right-hand side? So that's
let's still focus on this a bit. So basically, let's continue with our example of potentially from this 10,000, the biggest one is 76 million. So you say, take from the 10,000 the biggest loss, and if that's what you want to focus on, this is 76 million. That's a huge number. Average loss, sort of, I think I copy pasted something by mistake there. So average loss will be around here, around 100, 150,000. So I messed this up just before, I think, the presentation. I copied 5% rather than the actual value. So, but basically you can, from the distribution of the simulated loss, you can already see average loss, maximum loss, and the whole percentiles. What interesting, you can.
I think let's not switch, because Nirmala has asked a question about this sheet. Okay, so if we stick with this sheet, so Nirmala is asking about the 3 million and 26 million. So can we just explain that again?
Yes. So if you think of the 10,000 iterations we are running, trials here, and every time there is a one, it says, give me the log normal curve with these parameters, with this 95 percentile and the mode,
right?
And then I am producing lots of numbers, and the biggest of that number is 26. If I sort it by size, if I go and then I say copy and then paste and sort by size, this is the number.
Okay.
Biggest number.
That was the biggest number which was generated, which can change, right? If you run the model, it can change. So there's that much value on that precise number, but what it is telling you, it's giving you that, okay, that's the maximum maximum you need to consider in sort of your thinking around that particular risk.
Absolutely.
But of course, that 824, it can, next time when you do a simulation, it can be 1 million higher or 2 million lower.
Yeah, but basically, if you run around 1 million iterations, you will see that this number is around this 3 million, this 95 percentile. And this is the reason why you don't look at the maximum, but you look at some sort of a reasonable number. This 99.5 means you sort the 10,000 and take the 50th biggest, which is much more stable number than the biggest number, which is changing all the time. But take the 50th biggest, that is your 99.5% of the trials of the 10,000.
Right. So that 3.1 million is saying that 99.5% of the time there is a cyber attack.
That won't be bigger than that number. It will be below that number.
Yeah. So, okay. Yeah. So that 3 million or 3.1 million is what could be the financial impact, 99.5%. Okay. Which is quite a high occurrence. That from a day-to-day perspective, then that sort of is the number you would. So
basically what we are saying is, okay, you remember original one was 10 million, and we just sort of jumped this. So basically the 10 million impact gives you 5.8 million, but you remember that minus the second one with 5%, so half size of the extremal closable, we have now 2.7 million. So basically the value of your reducing from 10 million to 5 million is giving you 2.7 million reduction in your potential loss. So i.e., what's the true cost? So 2.7 million times my internal cost of capital. Let's assume at a bank you have roughly 10% of cost of capital, meaning, let me just get that again.
Yeah, but before we go to capital, Mustafa, so that number, if we go back to the previous sheet, so we understand.
That number again, risk number, this one. Yeah.
So that 3.1 million. So Nirmala's question is, which one would we consider for our risk assessment? So my understanding is we would consider that 3.1 million, right? Because that's 99.95% of the cases is where if we had a breach.
Yes, I mean, it depends now on the risk appetite. You see, for regulation purposes, if you are saying, I want to understand my pillar 2 number, I want to understand my pillar 2 number coming from, let's say, from 10 or 20 scenarios, then one of the scenarios is this scenario, data breach. Then for that scenario, the 3.1 million would go into that operational risk capital requirement. But for decision making, day-to-day decision making, it really is based on your risk appetite. Basically, how are you going to make a decision? Basically, if you're saying, I rather I'm happy with experiencing 3.1 million, and I don't want to invest the 500,000 pounds and reduce it to 1% as likelihood, or even the extreme plausible loss from 5 to 1 million, because I can actually maybe buy an extra data center or get extra staff, but it's going to cost me, 500,000 pounds. Then I'm looking at the cost of potentially of loss versus the cost of, making improvements in my control environment. So in that sense, the one way is to say, look, I want to make decisions across the business at the 99.5% level, i.e., I want to look at potential losses 99.5% of the trials. So all trials, 1 million or 1 trillion, but always I look at the same confidence level.
Yeah.
So there's no right answer to that one.
I understand. And so from a day-to-day perspective, is it fair to assume then that 99.95%, so the 3.1 million is what we would manage our day-to-day business on the basis of, but the maximum is where that if you had to go and look at insurance, buying insurance, or resilience perspective, making sure we have enough liquidity, then that's where the 26 million number then sort of comes from, beyond, if you want to go beyond the business as usual. But from the day-to-day perspective, what we are saying here is that if there was a cyber breach, then one cyber breach, 99.5% time will cost us 3.1 million. And then if there could be 2 or 3 cyber breaches in a year, then you need to sort of extrapolate that number, right?
Yes.
Because that's just one successful cyber breach we're talking about.
Yes. Absolutely. That's a good way of putting this. I mean, it's there's a bit of a couple of technicalities around what you said, but yes, in general, I agree with your statement.
Yeah. And if we were to convert this into another example of, let's say, mis-selling, so then each of those trial can be one mis-selling event. So if a salesperson mis-sells mortgage, then that one trial is representing that one sale. So you would have 10,000 sales, potential sales in this case, and then whatever numbers you input. So if we stick with 5%, then what you're saying is that 5% of the time a salesperson may mis-sell products to our customers, and then the Monte Carlo will then figure out what that number is, and then you get that 99.5% for that particular risk. In that case, 3.1 then represents the potential cost of mis-selling risk most of the time, 99.5% of the time.
Yes. So basically, in that sense, we are trying to be robust with our assumption and not precise. See, the whole thing is not making accurate calculation, but much more making roughly right calculations. So I'm rather precisely, roughly right rather than precisely wrong.
Yeah. And that's what we're trying. In this case, it's at least expanding that range. So right now, if we do just a drop-down selection, we're just getting 1. And then method I talked about, you're going from 1 to 4. In this case, you're going unlimited, or you can go 10,000, you can go 20,000, you can go 50,000. And that's why you need Monte Carlo, because for a human mind, it'll just be very difficult to comprehend. And it is always interesting then to compare your subjective input to Monte Carlo and see if the subjective input is really far away. That's where Monte Carlo can be used to validate whether the experts who are giving you those risk assessment responses, how far they would be from the Monte Carlo output.
I mean, it's very simple in this case. You can, in that sense, you put lots of, by the way, similar scenarios, similar risks, and then in a way aggregate all of them in one go. So you can have lots of sort of inputs around your scenarios, your various risks, and you attach again, these extreme plausible loss. In this case, worst case loss, typical loss, but all subjective, and probability all subject. And then you actually quickly run an analysis on that. So basically, let's do that. For example, data breach. So basically, in this case, was it 100,000?
Yep. So let's say 100,000, and worst case is, in this case, it's
5
5
million.
million. Yeah.
So basically,
say 5%. Yeah.
So business unit A, assign BDSF. So basically you are ready to run already quickly 100,000 trials.
Oh, wow.
So,
okay.
so then done already. So basically, let's see what it looks like. So basically, there it is. So you see, this is now the, and I can get even more, and I'll sort of announce on that. So basically, here is, we know it's a really fat tail because there's nothing in any other buckets, only at the very far right-hand side bucket, we have some numbers. So basically, what we have here, as you can see, even look at the distribution. Everything is on lots of zeros, but then there's tiny bit of number of sort of occurrence, actual losses, simulated losses around the number 3 million. So we know there's only one risk here, and you can even look at the OPRISK delta in this case. You can say, what if I actually improve the controls in this for this risk by 10%? Where how much value do I get from improvement? So then, in that sense, you can run another analysis. Let's say, look, what if actually instead of 5 million, this was only 2 million, keeping everything else the same, run the same analysis. Okay, let's create that. So, there you go. So that's your now your what if analysis. Basically, you quickly looked at your sensitivity of assumptions, and you can see actually quickly how strong your assumptions are. So basically, you can do all of that, and in a way, see how much this is really changing. Because, and also you are seeing how strong your assumptions are in that sense.
Yeah. So there's one question we can address from Stefan. So Stefan is asking about a scenario where, so if it's about system disruption. So on average, the disruption is 30 minutes. Worst case, the disruption may be 24 hours.
Yeah. So
what will I estimate the likelihood on? So in that case, the likelihood would be based on whether the disruption results in any financial impact for your customers. Because in this case, this analysis will only work if there is a financial impact. So if you have to go and pay compensation to your customers, if your systems are down for more than half an hour, or if you have to go and send a big email campaign to your customers. So Stefan, we will need to look at the cost associated with your disruption. And that's where, that's what we can then model here to see what would be, the Monte Carlo answer to the amount of financial impact of IT system disruption.
Yeah, so basically, but also what I understand from Stefan's question is, he says the worst case is 24 hours, and the most likely value case is half an hour, if I understand this right. So basically, you need to attach a certain cost to these duration. So your duration can be, in fact, even beyond 24 hours, because your 24-hour assumption is based on subjective, what you've seen in the last 10, 15 years, plus maybe what you've hear from the press or from other resources. So in that sense, the only way, again, to think of, beyond what you see is through Monte Carlo, through this extreme but plausible loss of 24 hours and half an hour, the typical, and then take that and then extrapolate beyond.
Yeah. So what Stefan is also saying is, Stefania, if there is no cost, let's say if for your IT system going down, if it's only lost opportunity, then that's where, so lost opportunity, I'm assuming then it's how many customers would have then bought some product from your website while the disruption happened. So that's where you will then need to look at how many typical customers, new customers do you get in a 6-hour window or a 4-hour window or a half an hour window, and then estimate that what is the potential revenue you would have made if you would have got those customers. And that's what then you can put into the Monte Carlo for simulation. Yeah, if you don't want to model the cost aspect.
Yeah, so absolutely. So basically, For some risks, you don't necessarily experience any losses, actual cash out of door, but it has still some revenue element. It has still some sort of element around, internally fixing it or not being able to do something else. So basically, opportunity cost.
So we have lost Pamela on their question, Mustafa. So can you just look at that question from Pamela? So how is the frequency / number of the occurrence represented here for the calculation of capital? Yeah, so I really didn't want to go into the calculation of capital because
that's fine.
I wanted to just stay with just the risk assessment. Are you able to address that question from Pamela on the frequency?
But I didn't understand the question.
The frequency and number of occurrence. So Pamela, is your question about any of the graphs here?
I got it. Yeah. Okay. So basically, let's go back to the graph. Yeah, here. So often people assign a frequency to an impact. So they say, this catastrophic has only, here in this case, a 10% chance of 10% likelihood. So in that sense, if the 10% is here frequency of this impact. But this is a funny terminology. It's a mix-up of terminology. But in the model of here, when we do Monte Carlo, you see this 5% likelihood. Actually, it just says how many of my 10,000 trials is a successful one. Here's one successful one. Here's another successful one. Yeah, is that okay?
Yeah. So frequency is equal to likelihood in the model. Is that correct?
Likelihood of the log normal model. If you sort of want to understand this way, yeah.
Okay. All right.
Okay. Yeah. But often there's a lot of mixing of these terminologies. So I need to see the actual explanation and what exactly has been said. Otherwise, there's so many different ways of explaining the same thing, and everyone is mixing this up, really, to be honest.
Yeah. So we've got 2 minutes to go. So hopefully that gives you a flavor, because I wanted to give a starting point, because the normal perception is that Monte Carlo is not for business people. It's only for PhD in stat type people, which is true if depending on how sophisticated, if you were building a big capital model for your organization, then yes, you need to be a PhD in statistics. But there is increasingly a lot of cases where Monte Carlo can really be useful, if not from a first point of assessment, at least to validate that whether your assessments you've collected from your experts, how far they are. That it can at least be used to validate that. And then the underlying sort of statistics, you just have to believe that, it's correct, that you just need to make sure that the numbers you are entering is correct from all the assumptions perspective, that they're valid numbers. And then when you get the output, it just becomes a sense check that at least we have something better than somebody's guess to go by. And then it'll raise that discussion on whether, are we in the same range? Are experts aligned, or
yes,
our experts are completely far off? And it should start that conversation. So we get a little bit more confidence that our risk assessment, the way we are assessing risk, is good quality. We can trust on those numbers. We can go and make business decisions based on those numbers. But if our experts and the Monte Carlo is really far away, then there is a question mark that either the assumptions of the Monte Carlo were not very realistic, or our expert, forgot to incorporate something into their assessment.
yes.
Then that, okay, there is a gap. So that's how I would recommend that, we use Monte Carlo to just validate.
Absolutely. But also, just to make the final point, this is not complex, really. You only need just logical information, and you don't need to understand any other assumption in the background to run any Monte Carlo. This is really simple.
Yeah, and we can provide then training to the people in the first line who will then need to do this, because then they understand the basics. So it's like using electricity, right? That when you want to use electricity, you just press the button and you get the electricity. You don't worry about whether the electricity was generated using nuclear or coal or natural gas, because all that then Monte Carlo will have that in the background. So far as you trust the statistics behind, then you're just pressing the button and you'll get light, and you do whatever you want with the light.
Absolutely, absolutely.
Okay, excellent. Mustafa, thank you very much for coming and sharing that with us. And then I will, if there are people interested in learning more about Monte Carlo, because of course, yeah, it's a little bit more than what we talked about today, but I wanted to give an introductory flavor. So if anybody is interested, then let me know and I can organize a separate session with Mustafa where we can drill down into Monte Carlo, into a little bit more if you want to learn more around this. Okay. So that's where we will end the session today. Thank you everybody for joining, and we will see you same time tomorrow at 1 o'clock UK time